Hey, welcome back. Intel has been a very rough investment since around the pandemic when they announced the Foundry plans that will shape the company's future. They fell a lot after the Q2 report for a few reasons and are now getting back to the lows from a year ago. The quarter was not really good, with the revenue, EPS and margin lower than a year ago and below expectations. We can see them developing and advancing the Foundry plans, which has an effect on the operating income. It has a minus 65% operating margin because they are investing so much and it's not a relevant source of income yet. That will eventually change, but it's a long-term investment. With this, they break even on an operating level, so the rest of the business makes around 2.8 billion, which could be better, but they say it's a matter of the environment. Probably the biggest announcement in the report was that they are implementing some more than 10 billion cost reduction plan while keeping up the Foundry investments. To do that, they want to fire more than 15% of the workforce and completely stop the dividend after already cutting it a lot. I remember saying when they had this cut about a year ago that this is no longer that slow, decent dividend payer anymore. They see this meaningfully increasing the liquidity and reducing the debt, which is something they really need right now. I'll talk a bit more about this in a second, but in my opinion this shouldn't surprise anyone, and you'll see why, and the fact that we see such a drop says a lot. They also gave a pretty weak guidance for Q3, and that was probably the last thing the market needed. But something actually impressive that I think the market missed, and they put it right at the end of the presentation, is that the adjusted free cash flow in Q2 was 8.2 billion. 5.9 billion was in contributions from the partners for the property, plant and equipment, which brought it into the negative a year ago, but even without it, they aren't doing that bad. Now that's the adjusted one. The non-adjusted was also negative a year ago because of all the investments. After the investment cycle, they should be around a break-even level in a market like today, but what will be the return on their Foundry's investments? But if the operating cash flow doesn't recover, even after the investment cycle is over, they might have issues. They would barely break even or worse, meaning that any dividend, interest, stock-based compensation and so on wouldn't be sustainable, which is a huge problem. They don't need a lot to pay them, but if they can't, it's still an issue. We can see the recent over 15% cut in jobs and them stopping the dividend as a way to reduce the bleeding. At such a capex, they either do this or cut the investments and risk ruining the company's potential. Not sure about such a high cut in workforce, but that can lead to lower compensation, but the dividend was very small and it wasn't really a time to pay it. But how likely is it to make absolutely nothing out of like 150 billion that they plan to invest? They are investing a ton of money into something with huge potential in the future. Even at around a 4-5% return, that alone is enough to pay for everything. This is potentially a 1 trillion market by the end of the decade, where they want to be the number 2. If TSMC can make like 14 billion in cash flows now with around 150 billion in property, plant and equipment, can't Intel make a third of that when the market is doubled? And that's, I guess, the potential. A recovery to 10-15 billion plus another 10-15 billion from the foundries would be huge for a 100 and something billion market cap company. Put it at the average ratio of around 15 and that's more than a 2-3x. Add the potential for some 10-15% dividends from the current level and you can see how this can do very well. But there is also risk and the market can be right, so nothing is guaranteed, of course. If the transition somehow doesn't work and they end up wasting so much money, this would probably be bought for scraps at a huge loss. But we'll talk more about this in the valuation later. Financially, they are in a pretty good position, with the current assets above the current liabilities and a still manageable amount of debt even if it doubled. The equity is now well below the market cap or around equal after taking the goodwill out, which is quite cheap for a company in the industry. Out of the companies that could benefit from AI, Intel stock is probably the one that gained the least. I'm not even going to mention Nvidia, but pretty much any company you look at has been doing much better than them. But if you think about it, all the foundries that they are investing massively in would benefit a lot even if Intel is not the one making the tech. They already offered this service to Nvidia a bit recently, and the more the competition develops, the more Intel has to gain from it. Either they fight a losing battle with companies that are far ahead in tech, or they find a way to benefit from them. And by the way, this thing with overall weaker tech might be true, but keep in mind that Intel is dominating anything CPU, GPU or whatever market thanks especially to integrated cards. It's not even close, but the market obviously has its favorites thanks to what you can do with this tech, meaning crypto mining and a lot of things related to AI. Still, I see the current business as a relatively stable cash flow provider, while the foundries represent a way for them to hedge and grow together with the market no matter who's winning. We can see the foundries developing well and already bringing a pretty significant chunk of the revenue. And I have to mention again the political and economical leverage they get by building these foundries in Europe and the US. Intel already has a massive political influence. You probably don't remember Intel's CEO being at Biden's State of the Union address like 2 years ago. Why? Well, because the company is key in the country's targets. I think no administration would go against this type of initiative. All the subsidies and incentives that they get from the US and Europe are in part the result of this kind of interaction. To some degree, instead of depending on TSMC, having this production capacity in your country is a matter of geopolitical and national security. Anyway, with 25 billion in capex and a negative cash flow, obviously the dividend, the 3 billion in stock-based compensation and so on are not sustainable. Unless they turn that into the positive, they will inevitably get into trouble. They already doubled the total debt since 2020 due to the Foundry plan, although the interest is still very low, below $1 billion, so something like a 2% yield. To be fair, that's basically free money given the current interest rate, so this is again probably the result of that influence. But they still have to pay it back eventually, so a negative cash flow doesn't help. You know, the dividend cut and firing people, the market is supposed to price in this kind of thing, not crash another 20% when they take some relatively inevitable step. Again, they can't keep piling up the debt forever, and if something doesn't happen fast, which is unlikely since this is something that would have visible effects in the long term, such actions should be expected. By the way, I'm now a Moomoo affiliate and you can get some really nice benefits while also supporting me if you sign up and deposit. Make sure to check out the link in the description or the pinned comment and see if you are eligible. This ad is for the US market residents, but you can get these benefits even in other countries. I just don't get paid, but I think it was too good for you not to accept it. Now, I think the valuation is actually pretty simple to do. In a negative scenario, if somehow the foundry business doesn't produce anything, they should probably still manage to make something like 5, maybe even 10 billion, especially now with the cost savings, but let's say 7.5. Sell the foundry business to whoever, maybe even Nvidia in the future if they want to save some money and not be fabless and depend on TSM anymore, and that should cover a majority of the debt. Put it at a ratio of 8, which is pretty much the company's low level, and that's a market cap of 60 billion and a price of around 14. That's around 40% less than today after the crash. They could probably pay some decent dividend from that level, so it would probably remain something for the pension funds as it was before. But if we see the foundry business adding even 15 billion in the future, which would be similar to TSM today, let's say they get to 25 billion in a normal year. At a ratio of 15, which would still be pretty low for a tech and especially AI company today, that's 375 billion. That would be a price of 87.7, meaning around a 4x from the current level, and this is not even such an amazing scenario. It can be better or worse, of course, but I think these two scenarios underline the risk and reward very well. Overall, I like Intel and I already bought it even recently, and I think it has a lot of potential. The financials are good even after doubling the debt, and once the investment cycle is over, even a smaller return on such massive investments can mean a lot of money. Again, all the potential thanks to AI, the political influence and so on traded around the value of the equity seems really good. Now, can they successfully do this transition? It's impossible to know. But from the current level, I think the market is pricing them for failure, opening an opportunity for me. It's a very small position right now, but if we keep seeing such prices, I'll probably keep adding over time. It's pretty unlikely to see the results improving overnight, so I'll probably have a couple of years to develop the position. As always, what I cover in my videos shouldn't be enough for you to make any investment decision, so please do your own research before investing in anything. If you want to see more videos like this one, please leave a like and even a comment to help me out, and make sure to subscribe. Thank you for watching, and I'll see you next time.